Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, have ETFs turned people into day traders? Of course, ETF being an acronym for Exchange Traded Fund. We're going to talk about that on today's show. We were unable to get to it last week, so it will be topic du jour on today's program. Also, your phone calls, your tweets, if you'd like to join the program to talk about a particular stock, mutual fund, ETF, or investment strategy, your retirement plan, you know the drill, 844-305-7800. Do give us your first name along with your city. On Twitter, you can find us at Index Show. That's my handle. So taking a look before we get into this topic of exchange-traded funds and have they converted the investing public into day traders or not, taking a look at what's going on in market action, Standard & Poor's 500 had its first setback in a week in almost a month. Almost a month, that's how good it's been for the S&P 500. It's been up, up, up. Well, this past week it was down. And the mood swing triggered by worries that the U.S. is not going to be able to come to terms on a trade deal with China and Canada. Those of us that have said, well, Trump is bad for the market, the question I pose to you is, which market are you looking at? Because if we take a look at the total U.S. stock market since the beginning of the year, it's ahead by just over 9%. We're going to take a look at what's going on industry sector-wise because that's going to really tell us which parts of the market are moving and which are not. But the point is that Trump has not been bad for the market. He's been quite good for the market if you take a look at price action. Of course, there is going to be volatility and ups and downs, as we're seeing here, because of the fact that there is a lot of concern about the negative impact of this inability of China and the U.S. and Canada and the U.S. to come to a trade agreement. So as that plays out, the thing I want you to keep in mind is when a deal is reached, and I believe a deal will be reached, but before a deal can be reached, there's going to be a lot of tug of war. There's going to be a lot of drama. There's going to be a lot of banter back and forth, a lot of rhetoric. But in the meantime, I want you to focus not just on that, but I want you to focus on other things. We talked about this a couple of weeks ago on the program. We can't just be looking at single pieces of news and making investment decisions. We can't just say, well, you know, trade tariffs, this is going to be bad for the market, and extract that one piece of data and make financial decisions based upon that. We've got to take a look at the entire picture. What are corporate earnings? What are the momentum, or where are stock prices? Where are they moving? What about volatility? What about other things like as far as your own portfolio, your asset mix? Do you have the right mix of investments that will help you to reach your goals? So you have to take a look at the big picture. And this is what we're trying to help you understand, is not just to take single pieces of data and make long-term or even short-term investment decisions based upon that, because I think it's going to trip you up. So that's what the total U.S. stock market is doing. Ticker symbol SCHB is one ETF that tracks that area. Like I said, up just over 9%. A pretty good return if you've bought and held. Now, if you take a look at other major asset classes, you'll see that U.S. stocks are effortlessly outperforming. And by a pretty significant margin, total U.S. bond market is down 1.5% for the year. We've got the global real estate market, REET, up 1.8%. We've got commodities as a group down 3%, USCI. And then we've got international and emerging market stocks, which have not done well. VEA, which tracks developed market stocks, down about 5%. And then emerging market stocks down just over 11%. So, again, that's your global perspective. That's your big picture view of what's going on in financial markets. And like I said, focus on the trend. Also, look at earnings. According to FactSet, there's been a record high percentage of S&P companies outperforming earning per share estimates for the second quarter. And this just came out, this report last week. More than 99% of the companies in S&P 500 have reported actual earnings numbers for second quarter. And of that amount, 80% actually reported earnings per share above the mean estimate. And that, according to FactSet, was a record percentage high in terms of companies outperforming or beating earning per share estimates. And so, again, this is another fundamental measure that we should be looking at in conjunction with all of the other facts, and that tells us about the health of the stock market. And right now, based upon what we see in earnings, very healthy action. Now, what's going to happen first quarter and second quarter of 2019? Well, that remains to be seen. I think we're going to see some hiccups with that, especially for some of these companies that have a lot of exposure to China and are suffering, at least temporarily, from the trade discrepancies and trade problems that are currently, and tariffs that are currently going on between the U.S. and China. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here. By way of reminder, if you ever miss our regular radio broadcast, you can pick up our podcast. It's available at iTunes. You can also find us at our website, indexshow.com. Google Play, we're there also, as well as YouTube. Again, just search under the Index Investing Show, and you shall find us. So, taking a look, like we just gave you a wrap on what's going on in terms of global markets. We're going to take a look a little bit later at what's going on with specific industry sectors and what sectors are driving the market. So stay tuned for that. On our Twitter feed, a couple of things I want to share with you. Dawn Wells, who played Marianne on Gilligan's Island, is asking her fans for financial assistance. She was trying to raise $180,000 on GoFundMe to pay for medical bills and IRS penalties. This was that show called Gilligan's Island. So I guess this has become the new, well, maybe not new, but the Hollywood retirement plan. Is that what we should call this? The Hollywood retirement plan, where we just go open up a GoFundMe account and we seek the support of our fans, of our base. Ask them to pay for our financial needs. Now, I'm not by any means being in, what's the word? I'm not by any means being heartless as to her problems right now, but I am questioning the fact that is this the way to properly plan for these types of events? It's something we can think about personally in the context of our own financial plan, our own retirement plan. What are we going to do? Are we going to seek the help of others in our time of need because of the fact that, well, we didn't plan properly, we didn't plan correctly, we didn't think about these things like medical bills? This is what we call the Hollywood retirement plan. That's what I call it. You can read more about it at Index Show on my Twitter feed. Also, social capital, once among Silicon Valley's elites, well, the magic pixie dust for social capital is gone. They are imploding. I've got an article linked to that. You can read all about it. Today's hot shots are tomorrow's turkeys. Don't forget it. This is the Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, a couple of we already told you what's going on in the broader market in terms of equity performance, and we need to update you, though, about what's going on sector-wise and some major changes. One of the things I want to tell you about real quick is on September 28th, there's going to be some big changes. We already told you about this, I think, about a couple of weeks ago. We had Dan Dolan from the Sector Spiders on the program, and we talked about the upcoming changes with the technology sector and the new communications industry sector. And now we've got some of those changes coming to fruition on September 28th. And the S&P 500 is going to be reshuffled, and we're going to see some of technology's biggest names, biggest stocks, such as Facebook, Netflix, and Alphabet, officially become part of the newly minted communication services sector. And the ticker symbol for that communication services sector is ticker symbol XLC. And so that industry sector ETF has already been up and running since mid-June, and you can jump on board right now. XLC contains Facebook, Netflix, Alphabet, and a whole bunch of others, but those stocks are going to be coming out of XLK, which tracks the broader S&P technology sector. And so that's a big change that will be happening again on September 28th, formal reshuffling of sectors within the S&P 500. But this is already available to you. You can make your changes now. You don't have to wait till September 28th because XLC is already trading. And in case you're wondering, also, I wanted to tell you, we often refer to the Sector Spider website and URL. Well, they also now have an app that you can download at iTunes, and I've been testing it on my iPhone and my iPad, and man, it is a great, great app. It works fantastic. It looks fantastic, and it breaks down the 11 S&P 500 sectors very visually easy. It's a great interface, and it's nice to be able to look at really quick. Communication sector, XLC, has 26 holdings in it. I'm using the app right now, as a matter of fact. And those 26 holdings, you can find out exactly what those holdings are. I tell you everything about the dividend yield, the average volume, all the things that you want to know about the fund. As far as the top holdings in XLC, because I know you're wondering that, we already told you Facebook is going to be the biggest holding. It's going to represent, or currently represents, almost 18% of XLC. You've got Alphabet, the C shares and the A shares, and then you got Comcast, Verizon Communications. Those are the 5 top holdings in XLC. And then just behind Verizon, you've got Walt Disney, you've got Charter Communications, AT&T, Activision Blizzard, and then Netflix. So again, these are some of the companies within XLC. Many of these companies were formerly part of XLK. XLK, you're wondering, well, if those companies, those are formerly tech companies, well, what is XLK going to now represent? What is it going to hold? If they're getting rid of Facebook and Netflix and Alphabet, what is it going to hold? Well, the answer to that question, and the app tells us, XLK, is going to primarily cover companies with internet software as well as services, IT consultants. What about semiconductors? That's a big area. You've also got computers and peripherals. You've got the diversified telecom services and wireless providers. That's going to also be remain inside XLK. And some of the companies that XLK will continue to hold, you think about those big software companies like Oracle and Microsoft, IBM, big services companies. So these are the components, the core components of XLK. And so that's what's going to be happening again at the end of September. 844-305-7800 is the number. We're here if you'd like to join us to talk about any particular stocks, ETFs, or investment strategies. Speaking of investment strategies, those of you that have not yet enrolled in my online classes, one of the things that we do on this program is we give you a investment philosophy that helps you to get ahead and stay ahead. And one of my flagship courses is titled Build, Grow, and Protect Your Money, a step-by-step guide. Go to indexshow.com and you can link on to the online classes. And that particular class I highly recommend for those of you that are looking for ways to shore up your investments. It's not just about building an investment portfolio and growing it, but it's also about protecting your money, especially when market conditions turn choppy. And quite frankly, we have not had a choppy market this year. It's been quite calm. We've had periods where the market has, volatility has spiked, but for the most part, it's been a pretty calm market. February, the market got kind of freaky. We saw volatility soared, but after that, it's been relatively calm. But that will not necessarily be the case in the future. And so now is the time to shore up your investment portfolio, protect your capital. I guess that's one of the key differences from my philosophy versus a lot of others that are out there, is that they're focused on building and growing money, but they forget about protecting it. And especially as you near retirement or get into retirement, protecting your wealth is so crucial. It's such a crucial exercise. I know it sounds simple, but if you're drawing, for example, 4% of your investments during retirement, and you suffer a drawdown of, let's say, 20, 30, 40% or more, now that means that you actually not lost that amount plus what you withdrew. And if that loss is not quickly recovered or continues into the following years, it can really begin to erode your nest egg very quickly. And so this is why having a margin of safety inside your investments is so crucial, especially for those that are nearing retirement or already in retirement. And so these are the things that I try to teach you. Again, indexshow.com. Check out that course, Build, Grow, and Protect Your Money, a step-by-step guide. 844-305-7800 is the number. We're here if you'd like to join us. Coming up a little bit later, have exchange-traded funds turn people into day traders. This is an argument that's been leveled and perpetrated at exchange-traded funds by people like John Bogle, which are anti-ETF proponents. Bogle has long been a hater of ETFs, and any suggestion that he all of a sudden embraces ETFs or was right about ETFs is completely wrong. The man has been wrong about exchange-traded funds since the early 2000s. He was the one that said, if you forgot, giving an ETF to an investor is like handing matches to an arsonist. So there's no way on earth he or anyone else, Bogleheads, can argue that Bogle was right about ETFs, because he has been wrong about ETFs the past 2 decades. And so I want to talk about this subject, have exchange-traded funds turn people into day traders, because I'm going to share some data with you that is going to open up your eyes about this subject. Before we do that, I want to just mention quickly on our Twitter feed, at Index Show, I've got a link to last week's, the previous week's show, the podcast, a checkup on the stock market's health, and also another show that we did called Portfolio Wars. Part 1 and Part 2, it was a battle of portfolios between Chris and Rocco. If you missed it, hit our Twitter feed, at Index Show, and you'll get the link. More when we return. Go nowhere.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Okay, on the Twitter feed, a couple of other things. Man, there's been a lot of stuff on the Twitter feed. We've been very, very busy. But I've got a retweet of money in Venezuela. It's actually a video at Index Show of a kid playing in a pile of Venezuelan bolivars. Bolivar is basically the equivalent of the U.S. dollar, and it just shows you it's just a pile of money, bolivars, Venezuela, and of course the money's worthless. And he's just playing in it. It's like confetti. Pretty amazing picture of what goes wrong, things that can go wrong when a country decides to print. And of course, the lesson for us here in the U.S. and other developed nations is what's happening in Venezuela could very well happen here. And some even argue that it's already happening, and already has happened with, of course, quantitative easing, basically what the Fed did. And so warning lessons for the rest of us, but an amazing video there of what's gone wrong in Venezuela and lessons for us. Also on the Twitter feed, a link to a New York Times article about how one of the largest robo-advisors called Betterment is introducing a way to get financial guidance from human advisors. Oh my gosh, robo-advisors. I mean, this is a desperate move. These folks have been promoting the idea that algorithms are the holy grail. Algorithms are going to solve the world's problems. Algorithms are going to solve your problems when it comes to retirement planning and investment planning, and it's faux customization is what it is, people. They make you download an app, and the way that it looks like it's customized to you. They're going to build a portfolio that is just right for you. But what it really is it's pre-programmed algorithms that are spitting out recommended asset mixes. But the point here is that for so long, from their various earliest days, robo-advisors have been dumping on human financial advisors, undermining human financial advisors. That's the premise of their business, that they can do it better than a human. And now all of a sudden they want to embrace human financial advisors? Are you kidding me? You want to talk about hypocrites? That's what robo-advisors are. Here's what I see happening, in case you're wondering why this is occurring. What's happened is robo-advisors have belatedly discovered, and I knew this years ago, they've belatedly discovered that they mispriced the cost of their services. They went so low on the cost of their services that they are not able to turn an adequate profit. In other words, they built their businesses incorrectly. And so now they're looking for sources of new revenue. And in order to get that, they're trying to embrace human financial advisors. They're trying to get human advisors on board with their nonsense to try to say, hey, we're going to help you build your business. We're a robo-advisor. We're all about, the best financial advice for people, no matter who they are. When in reality, it's just a reflection of the fact that they built their businesses incorrectly. They mispriced their core business, and that's what I see happening. But if I'm a human advisor, I would totally reject anything with robo-advisors. Stick to what you're doing. Come up with a business that cannot be easily replicated or duplicated by robo-advisors. Focus on that because when the next bear market happens, 90% or more of these robo-advisors are going to go out of business. That's what's going to happen. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here. So have exchange-traded funds turn people into day traders? Detractors of ETF investing, this is what they've been saying all along, that ETFs are one-dimensional trading tools that seduce people into hyperactive trading. Now, if we take a look at history, recent history, I would say the 1990s were a pretty big turning point in the public's attitude and behavior toward investing. Back then, the day trading culture took off as online trading gained popularity. People with non-financial backgrounds were suddenly piling into the stock market, hoping to strike it rich. Were ETFs behind that sweeping shift in the 1990s? Well, in retrospect, hyperactive trading was fueled by hot initial public offerings, also known as IPOs, focused on the internet and technology sector. So put another way, the argument that ETFs helped shape the day trading culture is not exactly true when we look at history. Likewise, today, the suggestion that ETFs are being used as standalone trading vehicles with no other purpose but to encourage hyperactive trading simply is not true. If we take a look at the facts, ETFs have become an important tool in both portfolio construction and management. Now, Morningstar's latest ETF managed portfolios landscape report, and I believe they publish it every quarter, but it shows that the total assets in professionally managed ETF portfolios held steady during the first quarter of 2018, just over $121 billion. 12 of the 20 strategies with the largest quarter-over-quarter percentage increases were in portfolios that were invested in plain vanilla stock and bond ETFs. And so what does it all mean? Well, the asset flow trends are signaling an increasing preference by investors for managed solutions, with ETFs being the primary building blocks. And rather than converting the investing public into day traders, ETFs have actually helped them, along with their financial advisors, to build portfolios that are more diversified, to build portfolios that are tax-friendly, and to build portfolios that are cost-efficient, or cost-efficient. In other words, lower ongoing expenses. So this is what's really unfolding. Now, what about the false but common assertion that the massive daily ETF trading volume proves that ETFs are being used to speculate? Now, this claim was made by John Bogle, the founder of the Vanguard Group, in a Barron's interview on May 21st, earlier this year. According to Bogle, the 100 largest ETFs have turnover of 785%, compared to just 144% for the largest 100 stocks. And so he extracts this data and he says, see, look, ETFs are being used as speculative trading vehicles. They're not being used as long-term investments or building blocks for portfolios. So if we dig a little deeper and we go beyond the superficial appearances of trading volume, which John Bogle has not done, his statistics provide little evidence that mom and pop retail investors have turned into ETF day traders. It's well known, and Bogle even knows this, and I don't think he discloses it in his arguments, but he should, that the bulk of ETF trading is done by large institutions. It's not done by retail investors. And that's the way it's always been since ETFs were first launched in the U.S. back in the early 1990s. It was always institutional investors that accounted for the bulk of trading volume. And that continues today. So if Bogle has a bone to pick about hyperactive trading or speculation, pick that bone with institutional investors. Preach to them, because they're the ones that contribute to this. It's not the retail crowd. So the argument that ETFs have turned people into day traders simply doesn't pan out. Now, I want to share one more piece of evidence with you, a study from Vanguard itself about this very topic coming up next.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, so if you're just joining us, 844-305-7800 is the number if you'd like to get in and join the conversation. If you'd like to talk about any particular stocks, mutual funds, ETFs, I am game. If you'd like me to analyze and grade your investment portfolio, or if you'd like to go head-to-head with another investor and see how your investment portfolio is really doing, go to portfolioreportcard.com and get in touch with me. That's where I take all requests for analyzing and grading investment portfolios. A, B, C, D, or F. Does your portfolio pass or fail? We'll find out. Go to portfolioreportcard.com. So taking a look before we continue our conversation about ETFs, have they converted people into day traders or not? I want to give you a quick update on a couple of very, very interesting areas and places where I see action in the market. We talked about the technology sector and communications and some of the changes that are going on with those two particular areas coming up later. But a couple of areas, those of you that say, well, you're just a one-dimensional bull. All you do is look at the bullish opportunities. Well, that's 1,000% untrue, because we look at opportunities in both directions, bullish or bearish. And for you bears, those of you that have been pouting about the stock market here in the U.S. achieving one high after another, and you're frustrated by that, and there's a lot of them out there, talking heads, pundits, that keep pontificating about how, stocks are overvalued. Stocks, they're overdue for a crash. And actually on our Twitter feed, about a week or two ago, we posted a nice chart showing how one after another has been wrong over the past several years. People from Harry Dent to Mark Faber and many others like them that continue to try to pick a top. And every step of the way, they've been wrong. And so for you bears, you want to focus on areas that are weak, areas that are trending down. And if you're not seeing that in the U.S., well then, open your eyes. Wake up. Look around the world. What areas are going down? I mean, it's not like you're chained to the desk and people are going to force you to only trade U.S. markets, because there's plenty of opportunities right now, especially for you bears, in the emerging market area. And we see a lot of emerging markets that have been on the decline. This particular group has been a weak performer over the past year. And from the start of the year, ticker symbol EDZ, which aims for triple daily opposite performance to emerging markets, EDZ is now ahead by almost 25%. And that's been a great trade. Emerging markets, I was bullish on them earlier in the year. I thought my goodness, they're look poised to outperform the broader U.S., but that changed. That changed once the arguments, not arguments, but once the fighting and disruptions of trade wars between the U.S. and some of these emerging markets like China began to unfold. That whole dynamic changed the trend for emerging markets. China, among one of the worst performers in emerging markets, ticker symbol CHAD aims for 100% daily opposite performance to Chinese stocks. That's been a great performer. But EDZ, as I said, is for you bears. So is CHAD. Those are two areas that again have been going down, and so EDZ, CHAD are designed to increase in value when prices in these emerging markets decrease. And so that's the value, that's the benefit of strategic-oriented exchange-traded funds, being able to take advantage of that downside by having ETFs increase in value. In other words, these are bear ETFs. A couple of other areas sector-wise that have been good places to leverage. Technology, TECL, that ETF aims for triple daily performance to tech stocks. It's ahead by almost 39% since the start of the year. And CURE, which aims for the same objective, triple daily performance to, in this case, healthcare stocks. CURE ahead by just over 31%. So again, we were helping you to understand that it's okay to be strategic. We want you to think strategic. We want you to take a look at the bigger picture. Don't just take a look at the S&P 500. There's global opportunities, and there are ETFs nearly for every single one of those global opportunities, long or short, that allow you to capitalize on that particular trend. 844-305-7800 is the number. And at Index Show is my Twitter handle. We've been talking about have ETFs turn people into day traders. This is a false argument. It's a narrative that's been pushed by anti-ETF crusaders like John Bogle, who have been wrong about exchange-traded funds. They continue to be wrong. He was wrong in 2001 when Vanguard first launched its ETFs. And they themselves published a report back in 2012 examining this very thing, ETF trading activity. And what do you know? Vanguard's own findings completely contradict John Bogle's entrenched arguments that ETF shareholders are short-term speculators. The study is titled ETFs for Better or Better. And that's a play on words, B-E-T-T-E-R, better or better, like you're betting at a casino, B-E-T-T-O-R. So they scrutinized more than 3.2 million transactions and more than 500,000 positions held in mutual funds and ETF share classes of 4 different Vanguard funds. They did this from 2007 to 2011. And by obtaining information from the transaction and account records of actual Vanguard clients, they were able to get a pretty close bottom line truth of how investors are really using ETFs. And what did they find? The results from the study showed that 99% of traditional mutual fund investments and 95% of ETF investments did not exceed a rate of 4 reversals or change in investment direction per year. Moreover, less than 1% of the ETF positions average more than 1 investment reversal per month. That is hardly a sign of ETF day trading. Moreover, the study revealed another promising trend, that both traditional mutual fund and ETF investments in Vanguard study were categorized as buy and hold investments. Over 60% of ETF investments were designated as buy and hold investments. The report's conclusion, and I quote, "We found little evidence of speculative behavior in either share structure," end of quote. That's from Vanguard. And so there you have it. The data simply does not support the narrative that exchange-traded funds are responsible for a mass conversion of the public to day trading. On the other hand, the data does support the trend that ETFs are being used more and more within a portfolio building and managing context. And this report, I've been told by Vanguard, it was published in 2012, so it's already been 6 years, is going to be updated with new data. And when that becomes available, you will be the first to hear about it, and we'll talk about it. And I know for a fact that it's going to support what the circumstantial evidence already shows, that ETFs are being used by investors as portfolio building blocks. And so that's what's really happening. So this narrative that ETFs have turned people into day traders is completely false. Well, that just about does it for another episode of the Index Investing Show. By way of reminder, you can pick up our podcast. It's available at iTunes, Google Play, as well as YouTube. Just search under the Index Investing Show. You can also go to our website, indexshow.com. There you can digest the podcasts, our archives. We archive every single show, and so we encourage you to do that. Also, you can get a portfolio report card at your leisure. We will analyze and grade your investments and tell you how you're doing. So until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.